What is going on, everyone, and welcome back to Crypto Insight Hub, the channel where we break down everything happening in the world of crypto, so you don't have to spend hours scrolling through Twitter at 2 a.m. I'm glad you're here, because today we have a lot to talk about. Markets are moving, institutions are making bold moves, regulators are getting loud, and there's some breaking news that is going to directly affect how some of you trade.
So let's not waste a single second. Let's get into it. First things first, let's set the scene with where Bitcoin is sitting right now. As of this morning, Bitcoin is trading at approximately $68,880. Now, if you've been watching this channel for a while, you know we've had a rough stretch. BTC was riding high earlier in the cycle and then pulled back hard, over 25% from peak levels. But here's what's actually encouraging today. Bitcoin has now held above $65,000 for several consecutive sessions. That's not nothing, that's consolidation. That's a market that's not in free fall anymore. It's a market that's looking for a reason to go higher. Analysts are closely watching the $69,000 level. If Bitcoin can flip that into a reliable support zone, meaning it stops there on a pullback and bounces, the next logical target becomes $70,000, which is a massive psychological barrier. A clean break above 70K could reignite a lot of retail interest and bring fresh momentum into the market. But we're not there yet. Right now, the name of the game is patience. What's keeping Bitcoin from falling further? Institutional inflows. Spot Bitcoin ETFs continue to see consistent net inflows from global asset managers. That tells you that even as retail sentiment has been shaky, the big money is still quietly accumulating. That's a critical data point. When institutions buy on the dip, they're not panic selling at the first sign of red. They're in it for the long game, and they tend to move markets in the direction they want eventually. Now, let's talk about Ethereum, because ETH is having a bit of a moment today. Ether is trading near $1,997 this morning, up about 1.78% over the last 24 hours. That might not sound explosive, but here's the context. This comes after a brutal weekend that saw over $540 million worth of Ethereum sold off in what analysts are calling a major sell wave. We're talking about a significant amount of ETH hitting the market in a short window, and yet Ether is rebounding. It's clawing back. It's heading toward $2,000 again, and that's a testament to the underlying demand that exists for Ethereum. Here's what's really interesting beneath the surface. Weekly decentralized exchange volumes on Ethereum doubled month over month, hitting $20 billion, and DApp revenue climbed to $26.6 million, narrowing the gap with Solana significantly. So while the price has struggled, the network itself is being used more. Volume is up, revenue is up, and Ether ETFs actually attracted $71 million in fresh inflows earlier this week, snapping a 3-day outflow streak. If Ethereum can hold the $2,000 support zone and build a base here, analysts are pointing toward a potential recovery target of $2,400. That's roughly a 20% move from where we are now. All right, let's talk about one of the biggest stories hitting the wires today, and this one directly affects Coinbase users. According to reports from Bitcoinist and several crypto community trackers, Coinbase users have been experiencing significant disruptions this morning. Some users are reportedly unable to buy, sell, or transfer crypto on the platform. Coinbase has acknowledged the issue and said their team is actively investigating and working to restore full functionality. The key message from Coinbase is this: your funds are safe. This appears to be a technical service disruption, not a security breach or anything that puts user assets at risk. But let's be real, this is deeply frustrating for active traders. If you're in a position and the market is moving and you literally cannot execute a trade, that's a serious problem. This is not the first time Coinbase has had service issues during volatile market conditions, and every time it happens, it reignites the debate about how much crypto still depends on centralized infrastructure. You've got a decentralized asset sitting on a very centralized exchange that itself relies on centralized cloud services. It's one of the quiet contradictions of this space that still hasn't been fully solved. If you're a Coinbase user and you're locked out right now, check their official status page for updates. And if this is a recurring pain point for you, it might be worth exploring hardware wallets and self-custody options so that your ability to move your assets is never at the mercy of a platform outage.
Now, let's move to one of the most fascinating macro-level stories in crypto right now, the intersection of crypto and American politics. The 2026 midterm elections are heating up, and the crypto industry is not sitting on the sidelines. The leading crypto super PAC network, Fairshake, entered 2026 with over $193 million in cash on hand. Let that number sink in for a second. $193 million ready to be deployed in federal elections, and they've already started spending it. Fairshake's affiliated PAC, Defend American Jobs, announced it will spend $5 million to support Republican Representative Barry Moore in Alabama's Senate race. Meanwhile, another affiliated PAC, called Protect Progress, is putting $1.5 million into opposing Democratic Representative Al Green in Texas's 18th Congressional District, specifically citing his votes against the Genius Act and the Clarity Act, two pieces of legislation that would define how digital assets are regulated in the United States. This is a story about power, and it's about the crypto industry flexing muscle it didn't have 5 years ago. The Clarity Act, which Congress is still debating, would create a comprehensive framework for how digital assets are classified and overseen. Getting the right people in Congress who understand and support this legislation is a priority for the industry. Crypto is no longer just a financial movement, it is a political force. Some people find this unsettling. Ohio-based Democratic strategist Jeff Rusnak has questioned whether crypto groups should be able to deploy what he calls essentially unregulated money in federal elections. That debate isn't going away. But what's clear is that the crypto industry has decided that if you want favorable regulation, you have to play the game. Let's pivot to Strategy, the company formerly known as MicroStrategy, because they dropped a statement today that turned heads. Strategy publicly said that it can survive even if Bitcoin drops all the way to $8,000. $8,000! That's a roughly 88% decline from today's price. Their plan, if that nightmare scenario unfolded, would be to equitize their debt, essentially convert debt obligations into equity to stay afloat. They have approximately $6 billion in debt, and they've structured their balance sheet to withstand extreme downside scenarios in Bitcoin's price. Now, Strategy is one of the largest corporate holders of Bitcoin in the world. They've been buying aggressively for years. The fact that they're publicly signaling their ability to weather catastrophic price drops is a deliberate confidence message to the market. They're not going anywhere, and they're not panicking. Whether you think their strategy is genius or reckless, you can't deny that their commitment to Bitcoin is unshakable. Now, here's a story that flew under the radar over the weekend, but is gaining traction today, and it involves one of Wall Street's biggest names making a serious DeFi move. Apollo Global Management, the asset management giant overseeing more than $900 billion in assets, is deepening its crypto push through a major deal involving MORPHO, one of the leading decentralized lending protocols. Apollo may purchase up to 90 million MORPHO tokens as part of a partnership designed to support the DeFi credit market. Let me be clear about what this means. A nearly $1 trillion traditional finance firm is buying tokens in a decentralized protocol, not as a side experiment, as a strategic partnership. This is the kind of institutional validation that the DeFi space has been waiting for. When a firm like Apollo buys in, it signals that decentralized lending isn't just a crypto-native niche anymore. It's a legitimate tool that traditional asset managers want to use and be part of. This could bring a massive wave of capital and credibility to the broader DeFi ecosystem. In regulatory news, OKX, one of the world's largest crypto exchanges, has secured a payments institution license in Malta.
This is a big deal for European expansion. The license aligns OKX with European Union regulatory requirements that are set to take effect in March 2026, putting them in compliance ahead of the deadline. This clears the path for OKX to expand its stablecoin offerings and crypto card services across the EU. For European users, this is a green light that OKX is building toward a legitimate, regulated presence in your market. Speaking of regulatory milestones, Animoca Brands, one of the biggest names in Web3 gaming and NFTs, has cleared a major regulatory hurdle, securing a new license in Dubai. The license allows them to offer broker-dealer services and digital asset management in Dubai, making the UAE city another key hub in their global expansion strategy. Dubai continues to position itself as one of the most crypto-friendly jurisdictions in the world, and companies like Animoca are rushing to establish their footprint there. And over in Hong Kong, the Securities and Futures Commission granted a license to Victory Fintech, marking the first new crypto company license the SFC has issued since June. Hong Kong has been working to rebuild its image as a crypto-friendly financial center, and this is a sign that the licensing pipeline is moving again. Several Hong Kong officials have also made public statements this week about advancing the region's regulatory environment, signaling that more approvals could be coming. Let's talk about Chainlink for a moment, because something significant is happening there. Saudi Awal Bank, one of Saudi Arabia's largest financial institutions, managing over $100 billion in assets, has announced it will integrate multiple Chainlink services for next-generation blockchain applications. This marks a clear shift in how Chainlink is being positioned, not just as a DeFi oracle, but as core infrastructure supporting real-world assets and institutional use cases. Simultaneously, CryptoQuant data shows that Link tokens are disappearing from centralized exchange inventories. When exchange supply drops, that typically signals long-term accumulation rather than short-term speculation. People are pulling their tokens into self-custody, which historically precedes significant price moves. Analysts are watching for a potential breakout as a classic double bottom pattern is forming in Link's price structure. The target some analysts are pointing to is $52. From where Link is currently sitting, that would represent a major move. On the macroeconomic side, Bank of America's latest survey just dropped something that every Bitcoin holder needs to pay attention to. BOA's February survey shows investor positioning in the US dollar has fallen to its most negative level since at least early 2012. That means institutional investors are placing their most bearish dollar bets in over a decade. And historically, a weakening dollar is one of the most reliable tailwinds for Bitcoin. When the dollar loses value, hard assets, whether that's gold, real estate, or Bitcoin, tend to appreciate as investors seek stores of value that can't be printed away. Gold is already leading the charge today, and Bitcoin tends to follow gold's macro narrative with a lag. If dollar weakness continues into the week, that could be one of the catalysts that finally pushes Bitcoin above the $70,000 psychological level. Let's do a quick check on a few altcoins that are in focus right now. Solana is up 0.45% on the day, holding its ground while most altcoins continue to struggle. SOL remains one of the most actively traded pairs on major exchanges and continues to draw institutional interest due to its speed and throughput advantages. Arbitrum, on the other hand, is facing significant headwinds. ARB is trading around 11.34 cents, down sharply from its highs of around 22 cents earlier in the cycle. The structure is bearish, with consecutive lower highs and strong sell-side pressure. Key support sits at around 10.74 cents. A close below that level could open the door to fresh lows near the all-time low of 9.44 cents. Momentum indicators are showing ongoing capital outflows for ARB, so if you're holding it, keep an eye on that support zone.
Bitcoin Cash is showing a different picture. A meaningful relief bounce from $423 has brought BCH back up to around $558. It's now pressing into resistance near $574, which is the critical level for bulls to clear. Tonight, there's actually a Bitcoin Cash meetup happening in Toronto, where developers are expected to deep dive into upcoming protocol changes, including the Layla upgrade scheduled for May. These kinds of grassroots events can act as unexpected catalysts, especially when they generate positive developer buzz. And Cardano is slowly clawing its way back after a brutal decline. ADA is sitting near 30 cents, up about 4% in recent sessions, and roughly 7% over the past week. Analysts are projecting a range of roughly 30 to 32 cents through the end of February, with a potential grind toward the upper end of that range if broader market conditions cooperate.
One more story worth closing on today. Metaplanet, the Japanese investment firm that has become one of Asia's most aggressive Bitcoin accumulators, reported that it expects its operating profit to rise 81% in 2026, after the company's profits literally soared 17-fold last year, largely driven by writing options on Bitcoin. However, the company did record a non-cash Bitcoin valuation loss of 102.2 billion yen, roughly $650 million, due to Bitcoin's price drop during the reporting period. The key word there is non-cash. They didn't lose real money in a liquidation. This is an accounting adjustment based on market prices, but it illustrates just how leveraged some of these corporate Bitcoin strategies are to price movement. So, let's pull all of this together and figure out what it means for the week ahead. Bitcoin is consolidating around $68,880, with institutional inflows providing a floor. The $70,000 level is the big test. Ethereum is recovering from a massive weekend sell-off, and the on-chain data is quietly bullish. DeFi is gaining institutional legitimacy with Apollo's MORPHO deal. Regulation in Europe and Asia is moving in a constructive direction for the industry. The political spending machine in crypto is firing up for the 2026 midterms, and dollar weakness could be the macro catalyst that finally lights a fire under risk assets. This is not a dead market. This is a market in transition, shaking out weak hands, building its institutional foundation, and preparing for the next move. If you've been holding and you've been patient, the data supports your decision. If you've been on the sidelines wondering when to step in, the setups are beginning to form. As always, do your own research, manage your risk, and don't put in more than you can afford to lose. That never changes no matter what the market is doing. If this video gave you value, smash that like button. It genuinely helps more people find this channel. Subscribe if you haven't already, because we're here every single day covering everything that matters in crypto. Drop your questions or your takes in the comments below. I read every single one. I'm your host at Crypto Insight Hub. Stay sharp, stay informed, and I'll see you in the next one.